In today's video, I'm going to give you the basics on investing. What is a stock? What is an ETF? What do all these random numbers mean? And of course, how to make a good informed decision on what to invest in. So first off, you need to have an investing account. You just can't go out and say, I want to buy 10 shares of that company. You need an investing account. There's many different investment accounts out there. In Canada, there is a TFSA, an RRSP, an RESP, as well as a regular margin or cash account. And each one does something different. So first off, the RRSP, Registered Retirement Account. Basically, what that does is you can put money into it, which then is a tax write-off for you. You can only put so much into an RRSP, and it's set by the government when it comes to your taxes. So for each individual person, it will be different. And then from there, when you invest into there, or when you put money into that account, now you can buy and sell stocks or ETFs or mutual funds or whatever you would like. However, there are a few things about that you need to know. So with an RRSP, an RESP, as well as a TFSA, you generally want to do safe investments. You don't want to do anything risky because those accounts, at least an RRSP and a TFSA, those accounts are going to be set how much you are allowed to put into those accounts, which then means if you put money into those accounts and let's say you lost like $1,000 on a stock investment, well, guess what? That is now $1,000 less that you can put into that account in the future. Even though it's disappeared and you've lost it, you still can't replace it. So you want to do safe investments in those accounts. When it comes to an RESP, that's an registered education account for kids, and then a TFSA, which is a tax-free savings account, which is where you would normally want to put higher dividend stocks and ETFs so that you can have basically tax-free income. And then there's a cash and margin account, which is something that is in Canada and the United States. And with those two accounts, basically it's whatever you make on the stock market is taxed, and whatever you lose on the stock market can be tax deductible, which is fantastic. However, let's get down to the stocks and let's just basically understand the numbers on what these numbers mean. What does it mean? What does all mean? What does all this stuff mean? Let's get over it. So there is a thing called an ETF, an exchange traded fund. Actually very similar to a mutual fund. However, there's one stark difference between them. With an ETF, your MER, or expense ratio, is extremely low, while with a mutual fund, it's extremely high. So with SPY, which is an American ETF, you're going to find that this one has a 0.09% MER. What does that mean? Well, for example, if you put $100 into this ETF, you would then be charged every single year 9 cents for the company that runs the Spider S&P 500 ETF. They want to make money themselves. They're not doing this for free. So, of course, they're going to charge you a fee for them to handle your money. And it's going to cost you 9 cents for every $100 that you put into it. Meanwhile, with a mutual fund, mutual funds are usually around 2.5% or more, which means that with a mutual fund, if you were to do something very similar with a similar type of an investment, which is called an index fund, that's what the SPY ETF is, you would then be charged $2.50 every single year, which is a heck of a lot more, especially when you start putting in more and more money than just $100. And why I say this is, with this MER, what you're hoping for is for your, for example, $100 investment to go up more than the 9 cents or higher than that $2.50 on a mutual fund. Generally, mutual funds are good for people who don't know how to invest, but at the same time, there's ETFs, and ETFs are cheaper. And you're probably saying, well, why is a mutual fund so much more money than an ETF? Well, sometimes mutual funds will have more human hands involved and will have more human hands on making decisions on what to invest in, while an ETF is generally an electronically traded fund. And when that is occurring, it's basically a computer that's generally doing the investing. Now, that's not always the case, but it is in most cases the case. Now, you're probably wondering, what is an ETF and what is a mutual fund? They are basically one of the same. And when it comes down to it, basically it's a fund that holds stocks. Now, SPY, which is an ETF in the United States, Canadians can also invest in it, basically is called an index fund, which means that it holds the exact same stocks as the top companies on the stock market at the same percentage as their weight on the stock market. So basically, if the stock market goes up, your money increases. If the stock market goes down, you lose money. And from there, the top 10 holdings of SPY is Apple, Microsoft, Amazon, Facebook, Alphabet, which is Google, Alphabet Class C, which is also Google, Tesla, Berkshire Hathaway, JP Morgan, which is a bank, and Johnson & Johnson. We've all heard of most of, at least 99% of those companies. And from there, generally speaking, a index ETF will be the safest thing that you can do. Now, what is a dividend? Well, a dividend is basically when a company makes money, they want to share it with their investors. And that allows cash flow to those investors so that those investors are happy. And of course, they can, in some cases, like myself, can use that as an everyday paycheck. So for example, people like me, I of course run my YouTube channels as well as I run a basketball training company, but I also make a lot of money on dividends, and that's what I use for my everyday expenses. And for a lot of people who want to so-called retire, start their own side hustle when they're younger, and then that side hustle can become a full-time job because of their investment income, this is how you would essentially do it. Or for people who are about to retire, you would be looking at trying to get as high of a dividend as possible so that you don't have to dig into your retirement savings. So for example, my father, he's retiring. He doesn't want to dig into his savings. He wants to dig into what the savings is making him. So basically how we have it set up for him is for his dividends, for him to live off of those dividends, and then for any of the capital appreciation that can then sit in the account, not have to pay taxes on it, and you only pay taxes on the dividends that are not being taken out of a TFSA. Because TFSAs, remember, are tax-free. So for example, this ETF does pay every quarter, so every 3 months. In this case, you would get $1.27 per share. However, you can see in this one that every quarter does seem to be different. So how you would want to invest into an ETF that has every quarter of their dividend being paid differently is to look at 1 year, let's say June 2019, because that's this month and also my birthday. And then you want to go 2019 to 2020. Did it increase? Well, $1.43.2 to here was $1.36, so it actually went down. However, the coronavirus struck, and that's why a lot of companies cut their dividends, and that's what happens. However, if we go farther back, we can see $1.24 up to $1.43, so we can assume that next year's dividend could possibly be better over and over again. But again, remember, with investing, whatever happened in the past is not necessarily going to happen in the future. Now, if you're Canadian, you can also invest in a very similar type of ETF, which is an index fund for the United States, and this one is the BMO one. And of course, what I'm going to show you here is their ticker symbol, which this one is ZSP, while the other one was SPY. Now, why is that important? Well, when you go on to your trading apps, so for example, I use TD and a few others. When you go onto those investment apps, you wouldn't type in, I want to invest in TD Bank, because, well, there's two types of TD banks. There's the Canadian stock and then there's the American stock. So you would look at that and say, well, why is there two stocks of the same name? Well, if you're Canadian, you would generally want to invest on the Canadian side and you would click the Canadian flag one. But if there's other banks or other companies that are very similar, for example, Tesla, if you want to invest in Tesla, there's actually two companies on the stock market called Tesla. There's a mining company and then there's Tesla, the car company. And when you look at it from a distance, you would say, well, I don't know which one it is. I'll take the mining company because it looks like it's cheaper. Well, guess what? It's a totally different company. So you would want to type in the ticker symbol, which for Tesla is TSLA, and that would allow you to get the actual stock that you're looking for. So it's always good to know the actual ticker symbol. And in some apps, if it's a Canadian stock, for example, TD works for the US and Canadian one. You could, in some cases, not all, the TD app doesn't work like this. But if you typed in on most apps td.to, that means Toronto. That's the Toronto Stock Exchange. That's the Canadian Stock Exchange. You getting it? I hope you are. I hope this is making sense. And then the next thing you want to do is look at the chart. Is it going up? Well, of course, there's always going to be dips in the market, and that's generally where you want to buy. You never want to buy when it's going up and you're saying, oh, I'm going to buy here. Then it goes down to here and you say, oh no, I just lost all my money, and I sell. And then it goes up again. You're like, oh, it's going up. And then it goes down a little bit and then you sell. You never want to do that. You want to buy when everyone is afraid, just like how Warren Buffett always says. And then you want to sell when everyone's on a high saying, oh, the stock market's never going to go down. That's when you sell. Or if you're like me and you just want to say, screw it, well, guess what? There's two types of stocks that I invest in, blue chips and casino stocks. Casino stocks being, in my opinion, Tesla, Sundial, AMC, GameStop, all of those. Tesla being a little bit more safer than the others, and I invest in Tesla. But from there, what you're kind of looking at and wanting to see is the blue chip stocks. When they go down, you buy more. When they go up, you just sit there and look at them and say, yay. Meanwhile, with the GameStop, with the AMC, with the Sundial stocks, where you hear these people online saying, buy and hold, hodl forever. No. What you want to do there is, let's say you buy 1,000 shares of Sundial, which right now I think Sundial is sitting somewhere in the $1.30 range. You buy 1,000 shares of that, it's going to cost you $1,300. And then at that point, if it doubles, so it goes to $2.60, you sell half. Now you've got your original money that you put in back, and you've got the part that has doubled, basically the house money, that's still in the stock. So now when it doubles again, so now it goes from $2.60 to $5.20, essentially at that point, you've got a lot more money. You have now made essentially another $1,300. You can take out and sell another half, and now you've got another $1,300 that's profit with another $1,300 that's still sitting in the stock. If it doubles again to, let's say, $10, or $10, what would it be, $10.40 or something like that, you would be then selling another half, which is another $1,300 in your pocket, and then you keep on going. But when it starts dipping back down, let's say it gets down to 90 cents again after going up to, let's say, $5, and it dips back down to 90 cents, well, guess what? You've already made that $2,600. You could go back in and say, well, I'm going to stick another 1,000 shares and see what happens. Because, of course, if this is a stock that you believed in before, what's changed other than the stock price? So if nothing's changed from when you believed in it before, then you invest more when it goes down, back down to closer to where you bought it originally, and then you invest more like I have recently. And then from there, if it doubles again to $2.60, then you sell half. You now make a heck of a lot more money, and you can basically have that going forever. And then you can find new stocks to do that with. I've done this with Tesla. I've done this with Sundial. I've done this with CGC, which is Canopy Growth. I've done this with Aurora. I've done this with a ton of different stocks. This is how you do it. You can also invest in individual stocks like I was just mentioning. Now, this is National Bank of Canada. This one's been a lover for me because it's been doing extremely well for me. It pays a 3% dividend, which means that, let's say, for example, you had $100,000 to put into a stock. I wouldn't necessarily always say put all of your money into a stock. I would never say that. You want to spread your money around and be diverse. But if you, for example, had $1 million to invest and you put $100,000 into National Bank, that means that you could conceivably make around $3,050 every single year divided by 4. And that would be how much you would be getting paid. However, there are other stocks and ETFs that pay a heck of a lot more than that. An example of that is a ticker symbol called TXF, as well as ZWK, which are ETFs, but they have an options twist to it. And if you don't know what options are, that's definitely not a basic beginner thing, so I'm not going to mention what that is, but they pay a higher dividend from their option premiums. If you don't know what I'm talking about, don't worry, I'll explain it in another video. And I think I do have other videos about what covered call options are, but that's essentially what these are. And TXF right now, TXF pays around 11%, and ZWK pays somewhere around 7%. Which means that if you invested, let's say, $100,000, you'd be able to make $11,000 a year from TXF and $7,000 a year from ZWK. Now, the thing is you can invest in banks and other stocks individually and not have to pay an MER like you see with the ETFs as well as mutual funds. And I really do want to mention this because there are ETFs that, like, for example, this one is ZEB, which is the BMO Equal Weight Banks Index ETF, which basically is an index fund, but it only covers the big 6 Canadian banks. And it pays, or you have to pay 0.6%, which is 60 cents for every $100 every single year. So that's not necessarily hugely expensive. However, if it's only carrying the big 6 banks, you could go out yourself and just buy the big 6 banks and have the highest weighting for the ones that you like most. And from there, you don't have to pay that MER, and you're still holding the exact same stocks. So long story short, before you buy an ETF or a mutual fund, see what's inside of it, see its past performance, see the dividends, see if it increases the dividends. Same as stocks. Make sure that the stocks are increasing in value if the companies that you're investing in are companies that share the same values as yourself, but also are continually making money. You don't want to invest in a company that's not making money, or at least not having a goal to make money someday. But from there, invest in companies that you know. Always consult somebody who you trust, who knows the stock market. Myself, I can be trustworthy, but I am a YouTuber. I am a random YouTuber to whoever is watching this. So there are a ton of us YouTubers. We may be pushing our each individual stocks and ETFs that we personally like. Like myself, I personally love the Canadian banks. That is my thing. I like their dividend. I like how well they do. However, you have to also look at other professionals who are actually professionals and see what they say. So I hope that this video is kind of giving you an insight on how to start investing, but also some ideas as to what to invest in, and see if you have the same goals as myself. My goal is to have the highest dividend possible so that I don't have to work and my money works for me. Anyways, I hope to see you guys again. Hit that like button, subscribe. I'll see you guys in my next video.